Good day, everyone, and welcome to Forex Street webinar. My name is Nenad, and today I will show you how you can define a reversal and retracement, because those are two separate things. Before we begin, our standard risk disclaimer, explaining that all online educational materials are available at Admiral Markets Estonia for a global audience. So if you want to get corresponding information and charting, conditions and any other detail, you should visit www.admiralmarketsglobal.com, select your country, and contact an appropriate entity. A risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. And final part, explaining that Admiral Markets UK Ltd takes no responsibility for information accuracy. This is my opinion, and Forex is risky business, so you should take it as that. This webinar is for informational and educational purposes. By logging into your trader's room on Admiral Markets account, you can definitely download Supreme Edition, which is restricted to 30 days of trial for demo accounts, and for live accounts, it's indefinite, so it's infinite. So you can download it and empower your MT4 platform. And don't forget that Admiral Markets has been officially the best MT4 broker. So with having said that, let's say that we will be talking about trend definition, impulsive move, corrective move. Then we will mention MACD reversal and correction. And I will give you additional tips when you are trading within the trend or you want to actually spot a reversal. So the primary thing which we will define today is what is a trend. So trend is a series of price movements which determines the main direction. Don't forget that trend is made by big money, by institutions, hedge fund traders, banks, central banks, commercial banks. Then foreign exchange trades, all of it define a movement. If that movement is synchronized, if the market is moving in waves and patterns, it creates a trend. We want to follow a trend because, as I already said, trend is a shark and you are fish who want to follow a big shark. An uptrend is a series of higher highs and higher lows. Simple as that. If anyone ever asks you about the trend definition, just tell him that uptrend is a series of higher highs and higher lows, and downtrend is a series of lower highs and lower lows. Trend exists on each time frame. So it doesn't matter if we take trade or we take a look at 1 minute or 1 week chart. 1 minute is a very fast chart, very fast time frame, and also you can define a trend even in that slow, very fast time frame. On slower time frames such as 4 hour, daily, weekly, monthly, we can also define a trend. The higher the time frame is, the stronger the trend is. So this is the standard zigzag pattern which we define a trend. Uptrend is higher highs and higher lows. Downtrend is lower highs and lower lows. Sideways trend is when market is moving in a range sideways. So trust, pullback, trust, pullback, trust, pullback. You probably know that each trend has a trust, impulsive move, and a correction, a loss of momentum, or retracement. Trust, pullback, trust, pullback. Downtrend is same. We have a trust, then pullback, trust and pullback, trust and pullback. We call it a bullish and bearish zigzag. Okay, so there are bullish and bearish zigzag. Impulsive move means that the price moves in trend direction. So let's say that we have a trend line and that we have a trend. So every time price makes a rejection from a trend line, and it starts going in trend direction, which is defined by zigzags, higher highs, and higher lows, we say that this is impulsive move. Okay? So this is impulsive move. Trading with impulse moves is faster. So you usually want a dip, then you want to take a buy trade. If you followed my analysis so far, I hope you have, you know that I always buy the dips and sell into rallies. That is very important for trading. So not from analysis perspective and from general knowledge, but from trading perspective, you always want to buy here and sell there. Now, if you want to go with the trend, you will buy here. You won't be selling. Okay? So you want to take an impulsive move in your favor. As I already explained, trend is moved by big fish, big money. Big money is running through market. You want to follow the shark. You want to go with the flow. You don't want to go against the flow. If you go against the flow, the chances are you might get trapped into a short trade. For example, in this example, short trades in a strong trend, uptrend, that can be disastrous to your account. Imagine if you try to short every single resistance on dollar CAD move. It won't do any good, and it won't be good to your account. Never. So it's always good to go with the trend. If you want to take a retracement, then be sure that it actually is a reversal or retracement, not just retracement, because you don't know how far the retracement will go. Take it with reserve. It's better to go with reversals than retracements. Okay, I will explain that. Forceful move in one direction, impulse move, a trend leg, next leg of buying. It's all the same thing. Traders say impulsive moves. For people who are not traders or who didn't trade in the past, it's just a simple uptrend move. You don't need to know every single definition. It's moved by a large amount of capital. And in order for a price to move one single pip, huge money needs to flow in market. Millions and millions and millions. Hundreds of millions just for a single pip. Impulsive move is governed by direction, momentum, strength, and wick, which is, for me and my trading style, more important than body of the candlestick. More important. Because if you see a candlestick like this, for example, you know that this is a hammer, right? And everyone knows this is a hammer. And every single trader knows that this is a bullish hammer, right? But what if you think a little bit deeper into the subject? I don't care if it's a hammer or if it's a pin bar or whatever Steve Nissen called those candles. I really don't care about it. What I care about is this. This defines historical buyers. This defines now moment buyers. This defines a current market flow, a bullish order block in order to move the market. I want to see history repeating, and you want to see history aligned with now moment. In almost every single analysis you have watched so far and you read so far, you will see that I really take care always of historical versus now moment buyers and sellers. So in the candlestick, this is much important to me. Very, very important. More than this body. I don't care. This is telling me that these are buyers here. Now, if I go to the left, I will see the history. Probably I will spot a lot of historical buyers from this place. Before I make analysis, I always look in the history to see whether there were buyers or sellers. If I want to go long, I want to see historical buyers. If I want to sell, I want to find historical sellers. When I do the analysis, I always go with the trend. So if trend is to the long side, I will compare historical buyers to now moment buyers. Past plus present gives us the future. Past plus present will give us profits. Simple things which connect Fibonacci and which connect all the universe, those things are governing my analysis. Simple yet effective things. Yes, it's confusing because I've spent a lot of time screening the charts, finding trying to find out every single logical point with the charts. And when I have found it out, I started to do full-time analysis. For me, everything is logical. I don't need to know every single name of a candlestick. I read about it. I know a lot about candlesticks. I read all Steve Nissen's books. But for me, in my opinion, most important thing is the wick. This pin bar is telling me a lot. A hammer, whatever, is telling me a lot. It's a bullish pin. It's a bearish pin. Shooting star, bearish pin. I love those pins. And this is what is the most important thing in a single candlestick. Now, their impulsive move is usually tripping stop move. So when you see that market is going up, and it doesn't have a retracement, that means that usually the move is governed by stop hunt. And when I say stop hunt, I think not stop hunt from broker, whatever, because when broker is regulated, it really doesn't exist. I have never witnessed it with other markets, never ever. And when I say stop hunt, I refer to stop grab. When big fish is actually moving a trend and collecting all stops of retail traders. And those stops are usually intraday stops. So when you see that there is a big move happening without any retracement, that means that stops are being grabbed. And that it creates even more impulse to the move. Okay? So, tripping stops created happens on any time frame. The bigger the time frame is, the bigger the move is, definitely. Consecutive momentum breaking previous lows highs, multiple candles of same trend, momentum in a row, and Heiken-Ashi is good example where you can spot an actual momentum, direction, and even a wick. You can do that also with Heiken-Ashi candlesticks. This is the example of Heiken-Ashi chart. Bullish candles. It doesn't matter. It can be also in Japanese candlestick. I will show you later on live chart. But here you can see impulsive moves, then correction, impulsive moves, correction. Look at this, impulsive move, correction. So remember, guys, okay, when you see that there is a big movement in a trend direction, that is impulsive move. So this was a downtrend here, right? And from this point here, we connect to trend line, bottoms, two price candle bottoms. It gives us two trend line touches. So this is a start of new trend, uptrend on intraday time frame, which is H1. So the start of uptrend, look at buyers here, and look at this, near-term historical buyers also. Why do I care about the candles? I don't care. I see this. It's enough for me. Historical buyers. This is zone for long trades. Okay, impulsive move has been started. Now we have retracement. Retracement gives us a second touch of a trend line. Okay, doesn't matter here. Then another impulsive move, another touch of trend line, another impulsive move, another touch of trend line, and finally a break of the trend line. So this is all impulsive move, guys. Up, up, up. It's impulsive. When market starts to go down, 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 from impulsive moves, we say retracement has started. Okay? So this is impulsive move, this is retracement. Impulsive move, retracement. Impulsive move, retracement. Impulsive move, retracement. Another impulsive move, now watch this, retracement. Trend line has been broken. Start of reversal, guys. Reversal, new trend. Impulsive move, retracement. Impulsive move, retracement. Now watch this part again, guys. Impulsive move, retracement, and so on. Until this point here. Reversal. Because you can see the trend has been weakened, and we can even see that some form of bearish wedge has started to form. Bearish wedge has been broken. Trend line important has been broken. And now this is reversal. Reversal precedes another impulsive move, which is a sign that new trend is being formed. Impulsive move, retracement. Look at this. Impulsive move, retracement. So this is, sorry, this is like this, it's easier. So reversal, then impulsive move, then we have basically a start of new trend. So now this begins to be an impulsive move, retracement. In downtrend, impulsive move is always a series of lower highs and lower lows. Retracement is when we have higher highs and higher lows within a trend concept. In uptrend, impulsive move is always higher highs, higher lows. And this is a simple retracement. Lower highs and lower lows within a trend concept. Okay? So, corrective move is slow and grindy market move. Price is still in a trend. Okay? It's still on a trend, but we use Fibonacci retracement to actually spot a retracement. So it's retracement. Every market needs a correction because the price needs to stay in equilibrium. Okay, who creates equilibrium? Big banks and central banks. Every single central bank governs its own monetary policy. When exchange rates starts to deviate from already incorporated, firmly incorporated monetary policies, central banks start to intervene. So every time there is a slight or big deviation from its monetary policy, central bank's job is to correct it, because every market needs to be and stay in equilibrium. Because it's not just a coincidence that Mr. Draghi, a president of ECB, said that he is prepared, and not he, but central bank is prepared for Fed's hike. Don't think that he personally didn't talk to Miss Yellen, and all of central banks needs to work together, especially when such big moves can happen. One of the reasons why I gave you Friday's analysis of euro dollar saying that bi-directional move is possible is that I used my own logic. Guys, correction is needed because this is most important. Price needs to stay in equilibrium. That is why we saw 1.1050 rejections. For all of you who attended my webinar yesterday with Admiral Market Session Recap, I said that we could see a sell at 1050 in euro dollar, and exactly that happened. Guys, whatever you want to, let's say that you probably thought that the market will go to 1.1012 or 1.1500, but it's not up to you. It's up to central banks. So using the simple logic that price needs to stay in equilibrium, especially before such an important meeting, the market is correcting itself. And the price has dropped 100 pips from my analysis, or watch Friday's analysis, doesn't matter, with Forex Street. So that is, it's simply the logic. When you trade, not when you trade, but let's say when you're an analyst, you need to understand both fundamental and technical principles. You need to do that. If you trade, it's not that important because usually you follow a system, grab few pips here and there, and you're happy. But guys, when you actually want to analyze the price, people need to believe you. So you need to connect every single bit, which is important in the analysis, to actually provide a good analysis. So I'm trying to explain a full logic. I don't have a lot of time. Well, actually, we have a single webinar for this. But I'm trying really to explain as simple as I can. A full logic behind all these moves. You should not be afraid of it. You should just accept simply as it is. Forex market, in my opinion, at least in my case, it's much better to be traded than stock market. Because especially indices. Because indices are a group of stocks, and because of that, they don't have clearly defined levels of support and resistance, which are the most important thing in Forex market. Levels of support and resistance, historical versus now moment concept, price action. Okay, guys. So this is the same chart, but explaining impulsive versus corrective move. So impulsive move, corrective move, impulsive, corrective. Trend line has been broken. Now this is impulsive move because this is reversal. Okay, corrective move, impulsive move, corrective move, impulsive move. So watch this chart. This is the logic behind impulsive move, retracement, reversal, another trend. So this is uptrend here. Now this is reversal. This is all retracement here, here. Those red candles in uptrend are retracement. And this is now a reversal with another impulsive move in, because it's reversal. Now it's downtrend. And we have correction here, then impulsive move, correction, and so on. Simple logic, guys. Okay? Impulsive move, correction. Now, this is impulsive move and this is correction. Very simple logic. Okay, guys? So this is another example. If you remember euro-dollar trade, this was a good euro-dollar trade. The price came to POC points and was rejected towards the main target. So this was uptrend. Now the price was very hesitant. It was a bit of a range. Inner trend line gave us a cue that now impulsive move has started. So we want to buy the dip in uptrend using my logic and Camarilla MACD principles. I have defined POCs within these price points. Of course, if the price broke, look at the history. Now, guys, look at the history. This was the chart from May. Look at this. And now we are in December. What did I say back in May? Below 1.1065 trend is bearish. This was May. And yesterday, and on Friday with Forex Street, and yesterday on other markets, I said sell 10.1050. Now I remember, and look how history repeats itself. This was May. And May chart told us that below 1065 trend is bearish. What happened is, guys, 100 and more than 100 pip move just from selling into this zone here. That is how history repeats itself in Forex market. Another example, impulsive move, retracement or correction. Do you know what is the other name, another name for correction? Another name is loss of momentum. So it's actually a loss of momentum. So when you see this, that means that momentum has been lost. But actually, guys, you want to exploit momentum loss when you want to take a trend trade. Sorry. Because this is a sign for you that retracement has been started and you want to sell higher. You don't want to sell here, right, when price is moving down. You don't want to sell into support. Because when price is going down, you have both momentum and trend. You want to sell when momentum has been lost, but the price is still within a trend. So you will wait for a rally in downtrend, or let's say in uptrend you wait for a dip. Because in downtrend, a loss of momentum or retracement is actually a rally within a trend, and in downtrend, loss of momentum is actually a dip in uptrend. Okay? So always pay attention to buying lower if the trend is to the upside. You don't trade impulsive move, you trade actually corrective moves. Because you want to buy the dip. When trend is to the downside, you don't trade impulsive move. You don't want to sell into weakness. You don't want to sell support. You are waiting for a rally to actually sell into rally. Buy the dip, sell the rally. Always buy the dip in uptrend, sell the rally in downtrend. Now this is clear. The point is you don't take trades when market is moving in impulsive move. You take trades on corrective moves, retracements, guys. Okay? Retracements, guys, for next sell. You want again to sell higher and in uptrend buy the dip, buy lower. Now, MACD is frequently used to identify momentum and retracement. MACD on charts give us valuable information about momentum and retracement. This part of webinar, now remember this, guys, I will schedule another webinar with Forex Street next month and I will tell you how you can define easily trend, a loss of momentum, and trend strength with MACD indicator. So this will be another part of webinar which I will schedule next month with Forex Street. Okay, let's move with webinar, then I will answer your questions. So this example shows strong correction without MACD. So just for your information, and we will use MACD for another webinar. Okay, guys, this is what we have been talking about this webinar. So this is downtrend. You see, this is downtrend. And this is a rally in downtrend. It's loss of momentum or retracement, right? Look where the price has been rejected. Okay, look at the history, guys. Look how many pins have been spotted in the history. Historical buyers, in that place, buyers turn to sellers in this place, and in this place was the near-term history. Price has been rejected again because there were historical sellers here. 78.6 retracement. It's called deep retracement. Now, this is defined by MACD, but I will explain that on next class fully. So once retracement starts, we don't know if it's reversal or not. Now, Gino has asked me, how do you know when the correction has finished and you can buy, sell? Do you wait for price action candles confirmation? Well, Gino, if you follow my analysis, it's too complicated to explain it this way. And of course, I cannot explain. But the thing is, I just watch higher time frame, compare it to lower time frame. For intraday, I use 1 hour. For swing, I use 4 hours. But I look at main trend direction. I just wait for, I'm just particularly looking at zigzags, okay, zigzags. Up, 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 down, 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 and compare it to higher time frames. But I cannot tell you about the logic of my analysis. It's impossible. It's too complicated, and it would take a lot of time and screening time and knowledge for that. So the simple explanation is, I will open a live chart in a few minutes and I will give you a simple explanation. That is why I also want you to follow next webinar about MACD, because for a trader who don't want to analyze and overanalyze charts too much, MACD is more, it's easier to go with MACD than price patterns. So this will explain. Once retracement starts, we don't know if it's reversal or not. All reversal starts from trend. So this is the path, guys. Trend, retracement, reversal. Okay, so we have a trend and we have reversal. We have a trend, impulsive move, reversal. Impulsive move or trust, retracement. I will go again because I'm talking too much now and I've lost the focus. So in a trend, we have impulsive move or so-called trust. Then retracement or loss of momentum or correction. Same things. Retracement is equal to loss of momentum, which is equal to correction. Then impulsive move, retracement. Impulsive move, retracement. Now look at this. This trend line has been broken. Gino, this is very simple way to identify if it's retracement or not. Trend line has been broken. Try to spot 4-hour time frame, for example. Now the price goes down. This is now a possible reversal. A reversal has started. When trend line is tested, guys, and price starts to move in new trend direction, we say that this is a reversal confirmation. Downtrend has started. So now in downtrend, we will have impulsive move, correction, impulsive move, correction, impulsive move, okay? That is the path. Trend, after a trend we see retracement, then finally we'll see reversal and next trend. Reversals are usually preceded by price pattern and candlestick reversal. Guys, these are candlestick reversal patterns. Bullish piercing line, 3 inside up, hammer, inverted hammer, dark cloud, piercing line. All of these patterns can give you cues for reversals. So when you combine trend lines and price patterns with candlesticks, you will have a better view at reversals, guys. So watch from rejection from support or resistance, retracements. When support is broken and retested, it becomes resistance. Price should follow new trend, new zigzag will follow us soon, and it's more reliable on higher time frames. I will open now a real-time chart and you will see how it goes. Let's use simple blank chart. This is simple blank chart. So guys, clearly you can define an actual retracement or reversal. Let's use past data. So in this example here, I will use 4 hour because 4 hour has less noise definitely than 1 hour. So here we can see a nice and strong uptrend. And definitely uptrend has started from this point. So here, guys, we had uptrend, but you see here, this was a rooftop. Let's say that the price has been ranging a little bit here and started a new trend. So dollar CAD is in a huge uptrend here. So you can see impulsive moves. So this is impulsive move. This is correction. Impulsive move, correction. Impulsive move, correction. Okay? Impulsive move, guys. And that is why I told you today, if you read Forex Street Analysis, dollar CAD, that you could buy the dip. Okay, so this was POC to buy the dip from, but definitely dollar CAD is in uptrend. So that is how we define a strong uptrend. So every time market starts to go impulsive, when it finishes with impulsive move, we place Fibonacci retracement. Okay, how to define a retracement? Watch me how I do it. This was obviously upswing. This candle is bearish candle. As soon as I see that bearish candle has started to form after impulsive move, I say, okay, this could be a start of retracement. Of course, I don't like 23.6 retracements because they are too shallow. I don't use it in my analysis, only when there is a strong trend. So 23.6 retracement is only valid when there is a strong trend, guys. So I want a dip a little bit lower, okay? And here we can see, we can even place another trend line here, okay? Okay. Okay, so this is another trend line, which has a confluence at 38.2 and a second touch of this trend line. So this is a little bit better, right? 38.2. So this could be a signal for us that the price may continue to go up from this point. Okay, now guys, when you see that the price is making a bearish patterns and trying to go lower, this can be a deeper retracement. That is why it's important to follow, basically to follow confluence. That is why I use always confluence within the analysis. Now, this is a good example of trend versus reversal. Here we have a downtrend, right? Here we have a big downtrend with almost no retracement. Okay, when you try to connect trend line, tops. In downtrend, you connect tops. Here, you can see we have a lot of touches here, right? So this is impulsive move, and this is correction. So if this was a swing high, you can define by placing Fibonacci retracement a possible retracement. And watch this, swing high, swing low, within a trend. Look, how many rejections? 61.8, a lot of rejections here, look. Then another swing, we will use it like this. This was swing high, and another swing low here. And look at this now, 88.6 rejection, trend line has not been broken. So watch this, always use previous swing with current swing. This is how I do it. So this is swing high, this is swing low, mini swing high, mini swing low. Almost not a swing high, but let's say swing high, swing low, and this is good swing high. This is swing low, this is swing high, this is swing low. This is much, much better swing high. This is, guys, now from this point, this is swing low here, but from this point, this is swing high, this is swing low. Now, from this point, this was swing high, and this was swing low here. Okay? We can even say this was a swing low, but retracement was not deep, only to 23.6. Here, guys, there is no retracement anymore. We have reversal, because this trend line has been broken, and price has made now a higher low. So this is high, this is low. Now we don't see a rejection with lower high. We have high, low, and lower high. So this is lower high, higher low. Simple, 1, 2, 3 pattern. 1, 2, 3. Okay, 1, 2, 3. Bang. High, low. Now this is a lower high, and this is a higher low compared to this and this. And trend line has been broken. When you see this, it's a very early cue that reversal has started and that the price is moving in a new trend which has been confirmed here. And you see up, 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 and up. So this is it, guys, what I was trying to explain. Of course, we will have, as I said, another webinar with MACD where I will explain how to actually use MACD indicator to help you in your trading decisions. And if you're not familiar with price action, you can use MACD, which is a bit simpler than this. But for all of you who love price action, this is, I think, very simple explanation how to actually spot the trend, retracement, and eventual reversal. Thank you for listening to me. Emmanuel is saying, hi Nenad, when is MACD webinar likely to be? Well, I will schedule it for January. So I think after New Year. So after New Year, we will have MACD webinar. So next webinar actually with Forex Street will be MACD. So and this webinar is being recorded, so you will be able to watch it multiple times. Well, in 45 minutes, guys, I hope that I try to give you hours and hours of knowledge. Of course, there is a lot more to talk about, but I try to put very simple yet effective things in 45 minutes. Thank you for listening to me, guys. I wish you a great weekend and great week. Don't trade tomorrow. We have important FOMC meeting. As I said, bi-directional move still possible with euro-dollar, and do not trade it. It's sometimes not having a position equals to having a profitable position. Thank you. Cheers, and trade safe.